America doesn't collapse with sirens and headlines. It collapses quietly. Inside the numbers, no one is watching closely enough. Right now, the US labor market is sending one of the most dangerous signals it can send. Not a crash, but a loss of momentum. Jobs are no longer absorbing pressure, they're starting to transmit it. Unemployment is rising, job creation is stalling, and past strength is being quietly rewritten through downward revisions and missing data. This is exactly how major downturns begin, not with panic, but with reassurance. By the time the damage feels obvious, the system has already moved past the point of control. The danger isn't that unemployment is high. The danger is where it is rising from and how fast the direction has changed. At 4.6%, unemployment doesn't sound catastrophic to people conditioned by crisis-era numbers. That's the trap. For years, the US economy relied on an unusually tight labor market to offset everything else that was breaking. Inflation above 3%, interest rates near cycle highs, collapsing affordability, and record household debt. Jobs were the shock absorber. Now that absorber is cracking. This isn't about crossing an arbitrary percentage, it's about losing momentum after saturation. When unemployment rises from historically low levels, it signals that firms are no longer expanding cautiously, they're defensively adjusting. Hiring slows first, then hiring stops. Only later do layoffs accelerate. The 4.6% mark matters because it confirms that the economy has entered that second phase. Context matters. The US added barely 64,000 jobs in the most recent month, effectively flat for a country of more than 330 million people. At the same time, prior job gains were revised lower by tens of thousands. That combination, rising unemployment alongside collapsing net job creation, is statistically rare outside of downturns. It means people are entering unemployment faster than the economy can absorb them, even before layoffs become widespread. What makes this moment more dangerous than past slowdowns is timing. Unemployment is rising after years of maximum labor utilization. There's no surplus capacity left to buffer the next shock. During earlier expansions, rising unemployment often came with strong wage growth or excess savings. Today, households are already strained by high prices, elevated borrowing costs, and shrinking savings buffers. A rising jobless rate now doesn't cool inflation, it amplifies financial stress. This shift also rewrites the growth narrative. Consumer spending makes up roughly 70% of US GDP. That spending was sustained not by real income growth, but by employment stability. Once unemployment starts climbing, even modestly, the psychological impact is immediate. People don't wait for job losses to cut back, they react to risk. That reaction shows up before the data fully deteriorates. This is why unemployment is a confirmation signal, not a warning. It confirms that pressure has already passed through hiring, corporate planning, and labor demand, and is now reaching households. Once that happens, the slowdown stops being theoretical. It becomes systemic. If rising unemployment confirms the system is losing balance, job creation reveals why the balance can't be restored. The added jobs sounds like a slow growth. In reality, for a labor force of roughly 168 million people, it is functional stagnation. At that scale, the economy needs closer to 150,000 to 200,000 jobs per month just to keep pace with population growth and labor force churn. Anything below that isn't expansion, it's erosion disguised as progress. But the more dangerous signal isn't the weak headline number, it's what happened behind it. The prior month was revised to show a loss of 105,000 jobs, the worst monthly drop since the economy was still emerging from pandemic shutdowns. Earlier months were also revised downward by tens of thousands. This matters because revisions don't change the future, they rewrite the past. They reveal that the labor market was weaker all along, even while markets, policymakers, and businesses were operating under a false sense of stability. This is the revision trap. Initial job reports are often optimistic because they rely on incomplete responses and statistical assumptions. When economic momentum is strong, revisions tend to move higher. When momentum breaks, revisions move lower, repeatedly. A pattern of downward revisions is one of the clearest indicators that the economy has already turned, even if the headline numbers lag behind reality. The danger escalates when weak job creation collides with rising labor supply. More people are looking for work, yet fewer positions are being created to absorb them. That mismatch doesn't stay contained. It spreads outward, first into underemployment, then into income volatility, and finally into demand weakness. This is how a slowdown transitions into a contraction without a single dramatic headline. There's also a sectoral issue buried inside the numbers. Recent job gains are increasingly concentrated in a narrow set of areas, while broader private sector hiring slows. That concentration creates fragility. When job growth depends on fewer engines, any disruption, cost pressure, demand pullback, policy shift, has an outsized impact. The labor market becomes brittle, not resilient. This is why weak job creation is more dangerous than outright job losses at this stage. Layoffs are visible in forced reactions. Stalled hiring operates silently. Companies don't announce what they choose not to do. Positions are never posted. Expansion plans are paused. Payrolls flatten without triggering alarms. Yet the economic damage compounds month after month. Revisions ensure that by the time the slowdown is fully acknowledged, the economy has already been operating below its assumed strength for quarters. Markets don't price the original data, they price the realization that the data was wrong. Once job creation stalls and revisions quietly erase past strength, the next signal doesn't come from headlines. It comes from who breaks first. Labor market stress never spreads evenly. It moves through the system along its weakest structural lines. That's why demographic shifts matter, not as social commentary, but as economic diagnostics. Right now, those diagnostics are flashing red. Unemployment among Black workers has jumped to 8.3%, up from 7.5% in just 2 months. That kind of move doesn't happen during healthy expansions. It happens when demand begins to retreat and employers start cutting at the margins. This matters because demographic unemployment historically functions as an early warning system. Groups with lower job security, higher exposure to cyclical industries, and fewer buffers feel downturns first. When their unemployment rate accelerates, it signals that labor demand is weakening at the edges, before it shows up in aggregate averages. By the time overall unemployment fully reflects that damage, the slowdown is already embedded. The timing is critical. This rise is occurring after years of maximum labor utilization. There is no excess slack left in the system. During earlier cycles, demographic spikes often happened alongside broader hiring momentum that could reabsorb displaced workers. Today, that absorption mechanism is failing. Job creation is already insufficient. Revisions are cutting backward, and now demographic stress is confirming that the slowdown is spreading laterally across the labor market. This is also where the macro feedback loop tightens. Higher unemployment in vulnerable groups translates directly into reduced spending in essential categories: housing, transportation, food, utilities. These are not discretionary pullbacks, they are forced adjustments. Because consumer spending accounts for roughly 70% of US GDP, even small contractions at the margins scale rapidly through the economy. The effect is non-linear. Weakness doesn't add, it multiplies. What makes this signal more dangerous than in past cycles is the absence of buffers. Household savings rates are already compressed, credit balances are elevated, borrowing costs remain historically high. When employment stress appears under these conditions, it doesn't slow inflation gently, it amplifies financial fragility. The system loses its ability to absorb shocks without breaking something else. This demographic shift also undermines the credibility of headline labor strength. Aggregate unemployment rates smooth over distributional damage. They hide acceleration in specific segments until it's too late to respond. When those segments begin deteriorating simultaneously with stalled hiring and downward revisions, the probability of reversal collapses. This is how downturns announce themselves, not all at once, but through the failure of the system's stress points. When the early warning sensors start failing, the rest of the structure follows. As demographic stress exposes where the labor market is cracking, the next danger is more subtle and far more destabilizing. We no longer know the full extent of the damage. In the middle of this slowdown, the US lost a critical piece of visibility. The October labor report was canceled, and key data from the household survey used to calculate unemployment, participation, and employment status was never fully recovered. That created a statistical blackout precisely when momentum was breaking. This isn't a delay. It's a blind spot during acceleration, the most dangerous moment to lose clarity. The distinction matters. Payroll data tracks jobs reported by employers. Household data tracks people, whether they're working, unemployed, underemployed, or leaving the labor force entirely. When household data is compromised, the system loses its ability to detect stress beneath the surface. Layoffs, reduced hours, multiple job losses, and labor force exits can all rise without being accurately captured. The result is a labor market that looks stronger on paper than it is in reality. This is not a technical footnote. Policymakers, corporations, and investors base trillion-dollar decisions on these signals. Interest rate policy, hiring plans, capital investment, and credit risk models all assume the data reflects current conditions. When that assumption breaks, decision-making becomes reactive instead of preventive. Mistakes compound. The Bureau of Labor Statistics itself acknowledged that the absence of October data made subsequent collection more difficult. That means November's numbers weren't just weak, they were built on incomplete foundations. In other words, the slowdown may already be deeper than reported, but the system lacks the resolution to confirm it. Markets aren't pricing deterioration, they're pricing uncertainty, and uncertainty is always repriced violently. This is where the risk accelerates. When confidence in the data erodes, confidence in policy erodes with it. The Federal Reserve is forced to choose between acting too late or acting on faulty signals. Businesses face the same dilemma: expand based on optimistic numbers and risk overextension, or pull back and risk triggering the very downturn they fear. Most choose caution. Hiring freezes don't show up immediately. Canceled plans don't make headlines, but they quietly drain momentum from the economy. History shows this pattern clearly. Major downturns are rarely preceded by clean, timely data. They're preceded by revisions, gaps, and sudden realizations that the numbers never told the full story. By the time clarity returns, the damage has already spread across employment, demand, and profits. This is why the current moment is so dangerous. Rising unemployment, stalled job creation, and demographic stress are unfolding inside a system that is partially blind. The guardrails are missing exactly when the road turns sharp. When the data goes dark, risk doesn't disappear. It concentrates. When visibility collapses, behavior changes first. Before layoffs surge or headlines turn red, workers adjust. That adjustment is already visible, and it's where the slowdown stops being abstract and starts becoming economic reality. Labor markets don't break only through job losses. They break through expectation shifts. When workers sense instability, rising unemployment, stalled hiring, unreliable data, they don't wait for confirmation. They pull back. Spending slows, risk tolerance evaporates, and discretionary decisions are postponed indefinitely. This reaction happens quietly, but its impact is massive because consumer activity accounts for roughly 70% of US GDP. The evidence is already there. Retail sales have flattened after months of deceleration. Auto-related spending has weakened despite incentives and financing support. Gasoline receipts are softening, a classic signal that households are cutting mobility and optional travel. These aren't random fluctuations. They are synchronized pullbacks across categories that historically weaken only when confidence erodes. What makes this phase especially dangerous is the starting point. Households are entering this slowdown with elevated stress. Inflation has stripped purchasing power. Interest rates have raised the cost of every major decision: cars, credit cards, housing, refinancing. Savings buffers that once absorbed shocks are thinner, and debt balances are higher. When workers pull back under these conditions, the slowdown doesn't glide, it drops. This shift also changes the nature of economic risk. Spending doesn't fall because income collapses overnight. It falls because uncertainty rises faster than wages. Fear becomes a financial variable. Workers delay purchases not because they can't afford them today, but because they don't trust tomorrow. That hesitation spreads rapidly because one household's restraint becomes another business's lost revenue. Once that loop begins, it feeds on itself. Lower spending pressures revenues, weaker revenues pressure margins. Margin pressure alters corporate behavior, not immediately through layoffs, but through cancellations, delays, and freezes. Investment plans are paused, hiring pipelines are cut, expansion assumptions are rewritten downward. The slowdown compounds before job losses dominate the data. This is why flat spending is not neutral. In an economy built on continuous consumption growth, flat demand functions like contraction. Prices remain elevated, costs don't fall fast enough, and volume disappears. Businesses are forced to choose between protecting margins or preserving workforce stability. Historically, margins win. The most alarming aspect is timing. This pullback is occurring while official labor data is incomplete and backward-looking. That means spending behavior is responding to real-time risk, not to what policymakers see on dashboards. By the time the data confirms the pullback, the demand damage is already embedded. This is how labor stress exits spreadsheets and enters the real economy. Not with collapse, but with retreat. And once workers retreat together, the economy has no choice but to follow. Once workers pull back, revenue weakens. When revenue weakens while costs stay high, corporations don't debate, they freeze. This is the phase where labor damage accelerates without immediately showing up in layoffs. Businesses are now facing a pressure structure that is historically toxic, slowing demand paired with rising input costs. Recent data shows manufacturing input prices at their highest level in more than 3 years, even as overall business activity slows to a 6-month low. That combination doesn't squeeze profits gradually, it crushes flexibility. Margins are the transmission mechanism. Over the last few years, corporations protected earnings through pricing power. That lever is now failing. Consumers are resisting higher prices, volumes are softening, and discounting is creeping back. At the same time, wages, insurance, logistics, energy, and financing costs remain elevated. For many firms, the math no longer works. When margins compress, hiring is the first casualty, not layoffs. Companies don't need to announce fear, they simply stop expanding payrolls, positions remain unfilled. Internal transfers replace external hires. Contractors are cut, overtime disappears. The labor market weakens without a single pink slip headline. This behavior is already visible across major sectors. Retail giants like Walmart and Target have warned about cautious consumers and tighter margins. Logistics firms such as UPS and FedEx have acknowledged slowing volumes and excess capacity. Automakers like Ford and General Motors are navigating weaker demand alongside high borrowing costs, forcing tighter capital discipline. Even scale leaders like Amazon have shifted from aggressive expansion to efficiency-first hiring strategies. This is not isolated weakness, it's synchronized restraint. Corporate finance explains why. When revenue growth slows below cost growth, management choices collapse into one priority: margin defense. Capital expenditures are delayed. Expansion plans are shelved. Hiring budgets are cut before layoffs are even considered. The goal becomes survival through uncertainty, not growth through risk. The danger is that this phase feeds directly back into the labor market. Hiring paralysis reduces job openings. Fewer openings increase unemployment duration. Longer unemployment durations suppress wage bargaining power. That further weakens consumption. The feedback loop tightens, not through shock, but through absence. Absence of hiring, absence of confidence, absence of momentum. What makes this moment particularly fragile is leverage. Corporate debt accumulated during the low-rate era is rolling into higher refinancing costs. Even modest revenue shortfalls now carry disproportionate consequences. A company that could absorb a 2% demand slowdown in 2019 cannot absorb the same slowdown with interest expenses doubled and margins thinner. Hiring freezes become defensive necessity, not optional caution. This is how labor markets fracture before they collapse. Not with mass firings, but with silence. No postings, no growth, no second chances. When companies stop hiring together, the economy doesn't slow evenly, it locks up. When hiring freezes spread and margins compress, the next signal doesn't come from press releases or official statements. It comes from markets. Because markets are forced to look forward when institutions are still debating the past. Markets reacted sharply to the latest labor data not because investors were surprised by weakness, but because the sequence was wrong. Weak job growth, rising unemployment, Downward revisions, demographic stress, and incomplete data are not supposed to appear together unless the cycle has already turned. Markets don't wait for confirmation, they price probability. And the probability they are now pricing is not a soft landing. It's a loss of control. This is why negative market reactions to weak labor reports matter. Stocks don't fall because the economy slows. They fall because slowing labor markets threaten earnings, valuations, and credit stability simultaneously. When employment weakens, consumption follows. When consumption follows, revenue forecasts break. When revenue forecasts break, margins collapse. At that point, equity prices are forced to reprice not on optimism, but on survivability. Bond markets reinforce this message. Rising uncertainty around growth and inflation expectations creates volatility across the yield curve. Long-term rates stop behaving like growth indicators and start behaving like risk premiums. Credit spreads widen quietly at first, signaling that lenders are demanding more compensation for uncertainty. This is how financial conditions tighten even without official policy changes. The economy doesn't wait for the Fed, it tightens itself. Equities, credit, and rates are all responding to the same underlying issue. The labor market is no longer a stabilizer. For years, strong employment insulated markets from inflation shocks, rate hikes, and geopolitical stress. That insulation is gone. Once labor becomes a source of fragility instead of strength, asset prices lose their foundation. This is why markets often overreact before downturns. They aren't overreacting, they are reacting to non-linear risk. Labor markets don't deteriorate in smooth lines. They hold, then slip, then accelerate. Markets price that acceleration early because once it begins, it feeds on itself. By the time unemployment spikes visibly, valuations have already adjusted or crashed. This forward-looking stress is now colliding with an institution that is structurally backward-looking, the Federal Reserve. The Fed is trapped in a dilemma that has no clean exit. On one side is inflation that remains stubbornly above comfort levels, sustained by structural costs, housing pressures, and supply constraints. On the other side is a labor market that is weakening faster than official data can confirm. Cutting rates risks reigniting inflation expectations. Holding rates risks breaking employment further. Either choice carries systemic consequences. The internal division within the Fed tells the real story. Rate cuts are no longer about stimulating growth. They are about damage control. The debate is not whether the economy is slowing, but how much pain policymakers are willing to tolerate and where it will show up first. Labor or prices? Jobs or purchasing power? Stability or credibility? This problem is magnified by timing. The Fed is making decisions with delayed, revised, and partially missing labor data. That means policy is being set in a fog. If the labor market is weaker than reported, policy is already too tight. If inflation proves more persistent than expected, easing too quickly risks another price surge. There is no safe calibration point when the data itself is unstable. What follows from this is critical. Policy mistakes become more likely precisely when confidence in policy is most important. Businesses sense this, markets sense this, workers sense this. That shared uncertainty is corrosive. It freezes decision-making across the economy. Hiring pauses, investment stalls, spending retreats. Not because collapse is guaranteed, but because clarity is gone. This is how downturns deepen without dramatic triggers. No crash is required. No single shock is necessary. A misaligned labor market, cautious consumers, defensive corporations, volatile markets, and constrained policymakers are enough. Once all five are present simultaneously, momentum turns negative on its own. The final risk is psychological. For years, the prevailing belief was that the labor market could absorb anything. That belief is now breaking. When belief breaks, behavior changes faster than models can adjust. The economy doesn't respond to forecasts, it responds to fear, caution, and incentives. That is where the system is now. The labor market is weakening, markets are reacting, policy is constrained, data is incomplete. And the most dangerous phase of any economic downturn is not when everyone sees it coming, but when everyone realizes too late that it already started.